Welcome to this explainer. If you've ever stared at your bank balance and wondered, what is my money actually doing when I'm not looking? Well, you are absolutely in the right place. Today, we're breaking down the hidden mechanics of your savings account. Okay, let's dive into this, because we're going to explore how your hard-earned savings aren't just sitting around idle. They are actually powering the entire economy.
Picture this. It's a super familiar scenario, right? You walk through those heavy glass doors of your local bank, step up to the teller, and deposit exactly $5,000 into a brand new savings account. The bank thanks you, you check your app, and yep, there it is. A year goes by, and the bank pays you a little bit of interest. Simple enough? We all have this comforting, kind of cozy illusion that our money is just resting there, locked safely away in a silent, static vault, gathering a little dust and a few extra pennies.
But actually, scratch that. We need to completely shatter that illusion of the static vault right now. And we do that by asking one fundamental question. Where does your money actually go? Because behind the scenes, something much, much bigger is happening. Your money is definitely not taking a nap. It is wide awake. Your savings are actively helping to power literally one of the largest, most dynamic financial systems in the world.
Let's start with layer one, pooling our resources. We'll look at this through the eyes of two young professionals. Lucas, who just deposited his very first real paycheck, and his friend Emma, who's about to show him where that cash actually goes.
Emma explains the whole thing using two really brilliant metaphors. First, think of a small village with a giant community well. Every single family pours a little bit of their own water into it. Some families don't need it today, while others desperately need it right now for farming or building a house. It allows the whole village to share the resource. Next, think of a massive library with, say, 100,000 books. That library works flawlessly because, thankfully, not every single person in town tries to check out every single book on the exact same day. And this brilliantly illustrates the massive gap between what we assume and how reality actually works. See, Lucas assumes his one deposit just sits completely still, resting quietly, or maybe it goes directly to fund one specific loan for one specific person. But the reality? Way more dynamic. Thousands or even millions of deposits are actively pooled together. The bank relies on the behavioral reality of fractional withdrawals, exactly like that library. Most customers simply do not withdraw their money at once. Because people are borrowing and withdrawing at completely different times, banks can carefully manage those deposits alongside their lending. It is a balancing act, not a gamble. This pooling of resources is absolutely crucial. It allows banks to maintain liquidity, meet some very strict regulatory requirements, and serve the needs of millions of customers simultaneously, safely, and efficiently. Which brings us to layer two, the business of banking. Now, we really have to address the elephant in the room here. If banks are actively using our cash to make things happen, why aren't they paying us huge, massive interest rates? To understand this, let's think about a grocery store for a second. When you hand cash to a cashier, that money doesn't just sit inside the register forever. The grocery store is a business. It takes that daily cash out of the register and actively uses it. They buy new inventory, pay the employees who are stocking the shelves, keep the lights on, and expand the business. Well, banks operate in a very similar way. Emma uses an Apple analogy to explain what's known as the interest difference. Imagine you're a business that buys apples for $1 each. That's step one. In step two, you sell those same apples for $1.20. Step three is really where the magic happens. You take that 20-cent difference and use it to pay for transportation, your rent, your employees, taxes, maybe covering any losses from a few literal bad apples. And if you're lucky, you leave a little bit of profit for yourself. Banks do the exact same thing. They pay you a smaller amount of interest on your eligible savings, but they earn a higher income from the loans they issue. That difference? That is exactly how the bank stays in business and covers its own operational costs and risks. So once we understand that business model, we can pull back and look at the big picture in layer three, fueling the financial engine. Think of the entire banking system like a massive, highly complex car engine. It requires fuel entering on one side to produce forward motion on the other. Now, what's really interesting about this concept is the definition of that fuel. Your savings deposits are the primary fuel that helps banks support literally everything else. Your money doesn't just sit still. It is actively transformed into the kinetic energy that keeps the whole economic engine running. Just think about the real-world impact of that pooled fuel for a second. Your $5,000, when combined with millions of others, provides the capital for a young couple's first mortgage. It funds the business loans that open up corner bakeries in your town. It powers car loans so people can actually commute to work. It backs education financing, and it makes sure global payment systems function smoothly. Your savings are directly impacting families and communities every single day. Seeing all of this, Lucas suddenly starts noticing bank advertisements everywhere. Open an account, start saving today. And it prompts a really great question. Why are banks always advertising? Why are they so desperately encouraging people to save? And why do they value our deposits so highly? Well, the answer is actually pretty simple. A larger deposit base gives the bank more fuel, it funds more lending, and it improves the bank's liquidity. But, it's also about building a long-term relationship. A savings account is quite often the front door. Once you're in, it introduces you to checking accounts, debit cards, mortgages, and eventually investments. A stable, long-term relationship like that provides reliable funding for the bank while offering comprehensive, lifelong financial services to you, the saver. Let's zoom back out to you, the individual, for the resolution, your personal safety net. Because while the system definitely relies on you, it is also heavily designed to protect you. Just compare keeping your money under a mattress versus in a bank. Under the mattress, it earns absolutely nothing and it is incredibly vulnerable to fire, theft, or just getting damaged. But in a modern, regulated bank account, you've got robust legal protections. Depending on your country, you're protected by deposit insurance up to certain limits, you have advanced security systems, and of course, the unbelievable convenience of electronic payments and instant transfers. A bank account isn't just about earning a bit of interest. It really is a fortress for your peace of mind. Let's move to and see how this builds over a lifetime. Imagine Lucas's financial journey. On day 1, he opens that very first savings account. Fast forward to year 5, and he has steadily built a healthy, highly liquid emergency fund. By year 15, well, his needs have evolved. He still keeps his savings for emergencies, for sure, but he is now investing separately for long-term growth. He's realized that different financial tools serve completely different purposes at different stages of life. Emma's final lesson makes this incredibly clear when we compare these two tools side by side. A savings account has a very specific job. It is your emergency fund, providing short-term liquidity and absolute security. An investment account, on the other hand, has a completely different job. It aims for long-term growth potential, but naturally, that involves a much greater degree of risk. I mean, you wouldn't use a hammer to turn a screw, right? And in the same way, you shouldn't use your short-term savings account to do the heavy lifting of a long-term investment portfolio. So the absolutely crucial point here is this. An emergency savings fund protects you from having to rely on incredibly expensive debt when, say, your car breaks down or a surprise medical bill arrives. But at the exact same time, your money is doing so much more than just waiting around for that emergency. It is actively connecting you, the saver, with borrowers. You are participating in a massive system that helps entire communities grow and thrive. Ultimately, understanding your savings account really means understanding your place in the broader global economy. So I want to leave you with this final thought-provoking question. The next time you open your banking app and check your balance, what is your money helping build in the world today? Thank you so much for joining me for this explainer. Keep learning, keep asking those great questions, and I'll see you in the next one.